Hello again. In this video, I will explain in simple terms what interest rates are, how they affect things like loans, savings, prices in stores, and even jobs. You will also see how one decision made by a central bank can slowly change everyday life without most people noticing it first. Interest rates are the cost of borrowing money, or the reward for saving money. That is the simplest way to think about them. If you borrow money, you pay interest. If you save money, you earn interest. Let's start with a very simple example. Imagine your friend lends you $100. He says you can return it in 1 year, but you must give him $110. That extra $10 is interest. It is the price you pay for using his money for 1 year. In this case, the interest rate is 10%, because $10 is 10% of $100. Now flip the situation. You put $100 in a bank. After 1 year, the bank gives you $105. You earned $5. That is interest. The bank paid you to keep your money there. The interest rate is 5%. So interest rates work both ways. Borrowers pay them, savers earn them. Now let's connect this to real life. When you take a loan, like a car loan or a home loan, you are borrowing money from a bank. The bank is not doing this for free. They charge interest. Let's say you want to buy a car that costs $20,000. You don't have that money, so you take a loan. If the interest rate is low, for example 3%, you might end up paying something like $21,200 over time. If the interest rate is high, for example 10%, you might end up paying $24,000 or more. Same car, same price. But the total cost changes because of interest rates. This is the first big idea. Interest rates change how expensive things feel, even when the price is the same. Now think about a house. A house might cost $300,000. Most people don't have that money, so they take a mortgage, which is just a long-term home loan. If interest rates are low, monthly payments are lower. More people can afford to buy houses. If interest rates are high, monthly payments are higher. Fewer people can afford to buy houses. So what happens when fewer people can afford houses? Demand goes down. Sellers struggle to find buyers. Prices may stop rising or even go down. This is how interest rates influence prices without directly changing them. Now let's talk about the bigger system. There is an institution in the United States called the Federal Reserve. People often call it the Fed. The Fed controls the base interest rate in the economy. This is not the exact rate you pay on your loan, but it influences all other rates. Think of it like the root of a tree. Everything grows from it. If the Fed raises interest rates, borrowing becomes more expensive across the whole economy. Banks raise their loan rates. Credit cards become more expensive. Car loans become more expensive. Mortgages become more expensive. If the Fed lowers interest rates, borrowing becomes cheaper across the economy. Now let's explain why they do this. The main goal is to control inflation. Inflation means prices going up over time. For example, if a burger costs $5 today and $6 next year, that is inflation. If inflation is too high, life becomes expensive quickly. People struggle. So how do interest rates help? When the Fed raises interest rates, borrowing becomes expensive. Let's go step by step. Imagine you want to buy a new phone for $1,000. You don't have the money, so you consider using a credit card. If the interest rate is low, you think, fine, I will buy it now and pay later. If the interest rate is high, you think, maybe I should wait. This is too expensive. Now multiply this behavior across millions of people. Fewer people borrow. Fewer people spend. Businesses sell fewer products. When businesses sell less, they cannot keep raising prices as easily, so inflation slows down. This is how higher interest rates reduce inflation. Now the opposite. If the economy is slow and people are not spending, the Fed may lower interest rates. Now borrowing is cheap. People are more willing to take loans. They buy cars, houses, electronics. Businesses sell more. They may hire more workers. The economy grows. But if this goes too far, prices start rising again. Inflation comes back. So the Fed is constantly adjusting interest rates to keep things balanced. Now let's talk about savings. When interest rates are high, banks offer higher returns on savings accounts. For example, you might earn 5% per year. If you save $1,000, you earn $50. This encourages people to save instead of spend. When interest rates are low, savings accounts might give you only 1%. You earn $10 on $1,000. That feels pointless, so people prefer to spend or invest. So interest rates also control the balance between saving and spending. Now let's bring in businesses. Businesses also borrow money. Imagine a company wants to open a new store. It needs $500,000. If interest rates are low, the loan is cheap. The company opens the store. If interest rates are high, the loan is expensive. The company delays or cancels the plan. Now think about jobs. If businesses expand, they hire more workers. If businesses stop expanding, they hire fewer workers or even lay people off. So interest rates indirectly affect employment. Now let's connect all of this into one chain. Interest rates go up. Loans become expensive. People borrow less. People spend less. Businesses earn less. Businesses slow down. Prices stop rising as fast. Inflation goes down. Now the opposite chain. Interest rates go down. Loans become cheap. People borrow more. People spend more. Businesses earn more. Businesses expand. Prices start rising. Inflation goes up. This is why people say interest rates control everything, not directly, but through a chain reaction. Now let's look at a full real-life scenario. Imagine interest rates are very low, around 2%. You decide to buy a house. Your monthly payment is $1,200. Your friend also buys a house. Many people are buying houses because it is affordable. Sellers see strong demand. They raise prices. Houses that used to cost $250,000 now cost $300,000. Now the Fed sees inflation rising. They raise interest rates to 7%. Now new buyers face a monthly payment of $2,000 for the same house. Many people can no longer afford it. Demand drops. Sellers struggle to sell. Prices stop rising or even fall. Same house, same market, different interest rates changed everything. Now let's explain one more important idea. Interest rates also affect expectations. If people expect rates to go up, they rush to borrow now before it gets expensive. If people expect rates to go down, they may wait. These expectations can move markets even before rates actually change. Now we bring everything together. Interest rates are like a dial that controls the speed of the economy. Turn it up, things slow down. Turn it down, things speed up. But it is never perfect. There is always a delay. If the Fed raises rates today, you don't feel it immediately. It takes months, sometimes more than a year, for the full effect to spread. That is why managing interest rates is difficult. Now finally, how this connects to supply and demand. When interest rates change, they influence demand. If borrowing is cheap, demand increases because people can afford more. If borrowing is expensive, demand decreases because people cut back. Supply is how much of something is available. Demand is how much people want it. Interest rates mainly move the demand side, and when demand changes, prices react. To learn more about supply and demand, watch this video next.